Something strange is happening in the housing market. Homes are sitting longer than they used to. Price cuts are appearing quietly in listing descriptions. And yet, headlines still talk about strong demand. But what if the real story isn't being told? What if the signals buyers should be watching are hidden beneath the surface, buried inside data, history, and patterns that most people simply overlook? Because markets rarely collapse overnight. They whisper first. And right now, the housing market is whispering. Pause for a moment and think about the typical homebuyer today. They open their phone. They scroll through listings. They see high prices, expensive mortgage payments, and bidding wars that still seem to appear in certain neighborhoods. The message they hear is simple. If you don't buy now, you'll miss your chance. But that message has been repeated before. Many times. And history shows that the loudest messages during a housing boom are often the most misleading. To understand what buyers aren't being told today, we need to go back for a moment. Back to another moment when the housing market looked unstoppable. The early 2000s. Between 2000 and 2006, home prices across the United States rose at a pace the country had rarely seen before. Cities like Las Vegas, Phoenix, Miami, and parts of California experienced price increases that sometimes exceeded 20% per year. Mortgage lenders approved loans faster than ever. New construction spread across suburbs. Entire communities appeared almost overnight. And the belief that real estate only goes up became deeply embedded in the national mindset. But beneath that confidence, something else was happening. Inventory was quietly building. Homes were taking slightly longer to sell. Speculative buyers were entering the market, people purchasing properties not to live in, but to flip quickly for profit. At first, those signals looked harmless. Small, easy to ignore. But they were early warnings. And by 2007, the market shifted dramatically. Prices began to fall. Buyers disappeared. And millions of homeowners suddenly discovered that their homes were worth less than what they paid. It became known as the housing crash of 2008, a financial crisis that reshaped the global economy. Today's market is not identical to that period. The lending standards are stricter. Banks are more cautious. And homeowners, on average, have more equity. But history does not need to repeat perfectly to rhyme. And some of the patterns that appear before a housing slowdown are beginning to reappear again. The first signal is affordability. Over the last several years, home prices increased much faster than incomes. Between 2020 and 2022 alone, U.S. home prices jumped by more than 40% in many regions. At the same time, mortgage rates began rising sharply. In early 2021, the average 30-year mortgage rate hovered around 3%. By 2023, it had more than doubled. That change alone dramatically altered what buyers could afford. A home that once required a $1,700 monthly payment suddenly demanded $2,800 or more. For many households, that difference was simply too large. But instead of prices immediately falling to match affordability, something else happened. The market froze. Homeowners stopped selling. Many people had locked in extremely low mortgage rates during 2020 and 2021. Rates around 2.5 or 3%. Selling their home would mean replacing that mortgage with one that might be more than twice as expensive. So they stayed put. And inventory dropped. This created a strange illusion. Low supply kept prices elevated. But the number of actual buyers capable of purchasing those homes quietly shrank. It became a standoff. Sellers waiting, buyers hesitating, and the market slowing beneath the surface. This is one of the most important dynamics buyers rarely hear about. Prices do not always fall immediately when demand weakens. Sometimes the market simply stalls first. Days on market increase. Price reductions appear. Sellers begin offering concessions behind closed doors. And transaction volume drops. That last signal may be the most important of all. In 2023 and 2024, home sales in the United States fell to some of the lowest levels seen in decades. Not because people stopped needing homes, but because the math stopped working. The monthly payment simply became too high. Yet this reality often receives far less attention than price charts. Because falling sales are less dramatic than falling prices. But historically, declining transaction volume has often been the first step toward larger corrections. Think of it like pressure building inside a system. At first, everything looks stable, but the activity underneath has already changed. And once that pressure becomes strong enough, the visible shift follows. Another signal buyers are rarely told about involves price reductions. At the peak of a housing boom, price cuts are rare. Homes often sell above asking price. Competition is intense. But when demand weakens, the first response from sellers is not usually a dramatic price drop. Instead, it starts slowly. A 5% reduction here. A $10,000 adjustment there. Small changes that might appear insignificant at first glance. But when those reductions begin appearing across hundreds or thousands of listings, the pattern becomes harder to ignore. In several US regions, that process has already begun. Listings that once attracted bidding wars are now sitting for weeks, sometimes months, and sellers who expected immediate offers are discovering a different reality. Silence. But the most fascinating part of housing cycles is psychological. Markets are not just driven by numbers. They are driven by belief. During a boom, buyers believe prices will continue rising. That belief pushes them to act quickly, sometimes irrationally. But when that belief begins to fade, behavior changes rapidly. Buyers wait. They negotiate more aggressively. They become selective. And suddenly, the momentum that once pushed prices upward begins to slow. This shift in psychology can happen gradually, then all at once, which leads to one of the biggest questions facing today's housing market. Are we witnessing the early stage of that psychological change? Or is this simply a temporary pause before another surge higher? To answer that, we need to look deeper. Beyond prices, beyond headlines, into the structural forces shaping the housing market today. Because there are several powerful trends quietly developing, trends that could reshape the market over the next few years. Interest rates, demographic shifts, construction patterns, and investor behavior. Each of these forces has influenced housing cycles throughout history, and each of them may hold clues about what comes next. But before we examine those forces, it's important to understand something many buyers overlook. Housing markets move slowly. Unlike the stock market, where prices can change in seconds, real estate often adjusts over months or years. That slow movement can create the illusion that nothing is happening, until suddenly the change becomes impossible to ignore. And in the next part of this story, we'll explore one of the most powerful forces currently shaping the housing market. Interest rates. Because the cost of borrowing money has always been one of the most important drivers of housing demand. And the recent changes in interest rates may be far more significant than many buyers realize. What happens when the era of cheap money truly ends? And what does that mean for home prices? That's where the story begins to get even more interesting. Interest rates rarely make headlines the way home prices do. They feel technical, abstract, almost boring to the average buyer. But in reality, interest rates quietly control the entire housing market. They determine how much a buyer can borrow, how much a monthly payment becomes, and ultimately, how high prices can climb before the system begins to strain. For nearly a decade after the financial crisis of 2008, borrowing money was unusually cheap. Central banks around the world pushed interest rates to historic lows. In the United States, mortgage rates frequently hovered between 3 and 4%. For buyers, that meant something powerful. They could afford more house. A family that might normally qualify for a $300,000 home could suddenly stretch toward $400,000 or even higher. Multiply that across millions of buyers, and something predictable happened. Prices began rising. Slowly at first, then faster. By the late 2010s, home prices in many American cities had already surpassed their previous pre-2008 peaks. But the most dramatic shift came in 2020. When the global pandemic struck, economic uncertainty surged across the world. In response, central banks again lowered interest rates aggressively. Mortgage rates in the United States dropped to levels never seen before in modern housing history. At one point, the average 30-year mortgage rate dipped below 3%. To put that into perspective, buyers in the 1980s once faced mortgage rates above 15%. So when rates fell near 3%, borrowing money suddenly became incredibly cheap. The effect was immediate. Demand exploded. Millions of Americans who had been considering buying a home suddenly rushed into the market. Low borrowing costs meant their monthly payments looked manageable. Remote work allowed many people to move farther from expensive city centers. And stimulus money added extra savings for down payments. The result was one of the fastest housing booms in modern history. Homes sold within days, sometimes hours. Bidding wars became routine. Buyers waived inspections. Offers tens of thousands of dollars above asking price became common. It felt like a race to buy before prices climbed even higher. But every boom contains the seeds of its own slowdown. And in this case, the turning point came from the same force that had fueled the surge in the first place. Interest rates. By 2022, inflation had begun rising rapidly across the global economy. Food prices increased. Energy costs climbed. Everyday goods became more expensive. To slow inflation, the Federal Reserve began raising interest rates at one of the fastest paces in decades. Mortgage rates followed. Within a short period of time, the average 30-year mortgage rate jumped from around 3% to more than 7%. That shift may sound small, but its impact on affordability was enormous. Consider a typical example. Imagine a buyer purchasing a $500,000 home. With a 3% mortgage rate, the monthly payment might have been around $2,100. But at 7%, that same home could require a payment closer to $3,300. That's a difference of more than $1,000 every single month. For many households, that difference changes everything. Suddenly, the home that once felt affordable becomes impossible to justify. And when millions of buyers reach that same conclusion at the same time, demand begins to fall. But here's the detail that often confuses people. When demand falls, prices do not always drop immediately. Housing markets adjust slowly. Instead, the first change usually appears in activity. Sales decline. Homes sit longer. Buyers hesitate. And that's exactly what began happening across many parts of the United States. By 2023 and 2024, existing home sales had dropped sharply compared to the peak of the boom. In some regions, transaction volume fell to levels not seen since the aftermath of the 2008 housing crash. But this time, something unusual happened. Prices didn't collapse. At least not everywhere. And the reason comes back to something economists now call the lock-in effect. Millions of homeowners had locked in ultra-low mortgage rates during 2020 and 2021. Rates around 2.7%, 3%, sometimes even lower. For those homeowners, their mortgage had become an incredibly valuable financial asset. Selling their home would mean giving it up and replacing it with a new loan that might carry an interest rate more than double. So many homeowners made a simple decision. They stayed put, even if they might otherwise have moved, even if their family situation had changed, even if they would have preferred a different home. They stayed, because financially, moving simply didn't make sense. This created a rare situation in the housing market. Demand was weakening, but supply was also extremely limited. Fewer buyers, but also fewer sellers. And that balance prevented the dramatic price drops many people expected. At least for now. But housing markets are shaped by more than just interest rates and supply. Another powerful force is quietly influencing the future of housing demand. Demographics. Who is buying homes? Who is forming households? And how those trends shift over time. For decades, the largest generation in American history has been the millennials. Born roughly between 1981 and 1996. And in recent years, millions of millennials entered their prime home-buying years. Their arrival created a wave of demand. New families, first-time buyers, people looking for larger homes in suburbs or smaller cities. This demographic surge helped push prices higher during the boom. But demographics also evolve. And some of the next trends could reshape the housing market in ways that buyers rarely consider. Because the next generation, Generation Z, is entering adulthood in a very different economic environment. Higher home prices, higher interest rates, higher student debt for many households, and wages that, in many cases, have not kept pace with housing costs. Which raises an important question. If affordability remains stretched, will the next generation of buyers be able to sustain the same level of housing demand? Or will the market need to adjust to match what buyers can realistically afford? History offers an important clue. Throughout the past century, housing markets have always been tied closely to income growth. When home prices rise much faster than wages for long periods, eventually something changes. Either incomes catch up, or prices correct. And that adjustment does not always happen smoothly. Sometimes it occurs slowly through years of stagnant prices. Other times it happens more abruptly. But one way or another, affordability tends to reassert itself. Which brings us back to the central question buyers are facing today. Is the housing market still adjusting to the rapid changes in interest rates and affordability? Or are we only at the beginning of a larger shift? To understand that possibility, we need to examine another critical piece of the housing puzzle. Construction. because the number of new homes being built and where they're being built can dramatically influence the direction of prices. In the next part of this story, we'll explore how builders, investors, and large institutions have reshaped the housing landscape over the past decade, and why their decisions may play a crucial role in what happens next. Because sometimes the biggest forces in the housing market are the ones most buyers never see. For years, one explanation has dominated the housing conversation. There simply aren't enough homes. You've probably heard it many times. A national housing shortage. Millions of missing homes. A supply crisis that guarantees prices will keep rising. But the truth is more complicated than that. Because housing supply isn't just about how many homes exist. It's about where those homes are, who owns them, and whether they are actually available to buyers. And over the past decade, something unusual has happened in the housing market. A new type of buyer entered the scene. Not families, not first-time homeowners, but large investors. Institutional investors, hedge funds, private equity firms, and massive real estate companies began purchasing thousands of single-family homes across the United States. The trend accelerated after the financial crisis of 2008. During the crash, millions of homes went into foreclosure. Prices collapsed. Entire neighborhoods suddenly had empty properties. For large investors with access to capital, the opportunity was enormous. They began buying homes in bulk, sometimes entire subdivisions at once. Cities like Phoenix, Atlanta, Tampa, and Dallas became major targets. Investors converted those homes into rental properties. At first, the strategy seemed temporary, but over time, it evolved into a long-term business model. By the early 2020s, institutional investors controlled hundreds of thousands of single-family homes across the country, and their presence changed the housing market in subtle ways. When large investors compete with regular buyers, they often have advantages. They can pay cash, they can move quickly, and they can purchase multiple homes at once. During the pandemic housing boom, these investors expanded their acquisitions even further. In some markets, investors were responsible for 20 to 30% of home purchases. That level of activity can significantly influence prices. Because when investors enter aggressively, they increase demand. But here's the part that buyers rarely hear about. Investor demand can disappear just as quickly as it appears. Unlike families buying homes to live in, investors make decisions based on returns. Rental income, interest rates, market expectations. If those numbers stop working, investors can simply step away. And in some cases, they may even begin selling. This shift is already starting to appear in certain housing markets. Rising interest rates have increased the cost of financing real estate purchases. Insurance costs have climbed in several states. Property taxes have risen in others. And rental growth, which once surged during the pandemic years, has begun to slow. For investors, that combination can change the entire calculation. A property that once looked like a strong investment suddenly becomes far less attractive. When that happens, demand from institutional buyers weakens. And that matters more than many people realize. Because investor demand helped push prices higher during the boom. If that demand fades, the market loses one of its strongest sources of momentum. But investors are only one piece of the supply puzzle. Another important factor is home construction. After the housing crash of 2008, builders across the United States dramatically reduced new development. Construction companies went bankrupt. Financing became difficult, and many builders spent years recovering from the damage. As a result, the pace of new home construction remained unusually low for nearly a decade. This slow building period is one of the main reasons economists often point to a housing shortage today. But construction has not remained stagnant forever. Over the past several years, builders began increasing production again. New housing developments spread across suburbs and rapidly growing cities. Large apartment complexes appeared in many metropolitan areas. And in certain regions, the number of new homes under construction reached the highest levels seen in years. But construction cycles can also create new challenges. When builders see strong demand, they respond by building more homes. The problem is timing. It often takes 1 to 3 years for a housing project to move from planning to completion, which means many of the homes currently being finished today were planned during the peak of the housing boom, when demand looked unstoppable, when mortgage rates were near historic lows. But by the time those homes are completed, the market conditions may look very different. Mortgage rates are higher, buyers are more cautious, and affordability is stretched. This timing mismatch has occurred before in housing history. Builders respond to strong demand, but by the time the new supply arrives, the market has already begun cooling. When that happens, inventory can rise quickly. And rising inventory is one of the clearest signals that the balance between buyers and sellers is shifting. In several U.S. regions, that shift is beginning to appear. New listings are increasing. Homes are sitting longer. Price reductions are becoming more common. None of these signals alone means a crash is inevitable. But together, they suggest something important. Momentum is changing. And momentum matters in housing markets. Because once buyers begin to believe that prices might stop rising, their behavior changes. The urgency disappears. Instead of rushing to buy immediately, they wait. They negotiate. They compare options. And when enough buyers adopt that mindset, the market dynamic transforms. Sellers suddenly face competition. Listings accumulate. And price expectations begin adjusting. But perhaps the most overlooked factor in housing cycles is time. Housing corrections rarely happen overnight. The crash of 2008 felt sudden to many people. But the warning signs appeared years earlier. Sales peaked in 2005. Prices slowed in 2006. And by 2007, the downturn had already begun. The full crisis simply took time to unfold. That same slow process could be playing out again today. Not necessarily with the same severity, but with similar early signals. Affordability pressures, declining sales volume, rising inventory in certain markets, and growing uncertainty among buyers. Which brings us to a critical moment in the story. Because the housing market is now entering a phase where several powerful forces are colliding at once. Interest rates remain elevated. Demographic demand is evolving. Construction is increasing in some regions. And investor activity is shifting. When multiple forces change simultaneously, markets often become unpredictable. And that uncertainty is exactly what many buyers are sensing today. But there is one final factor we still need to explore. A factor that has shaped every housing boom and every housing crash in modern history. Human psychology. Because ultimately, markets are not just numbers on a chart. They are reflections of how people feel about the future. Confidence, fear, expectation, and belief. When those emotions shift, markets can change far faster than most people anticipate. And in the final part of this story, we'll explore the most important question of all. What happens when the belief that home prices only go up begins to fade? Because when that narrative changes, the housing market can enter a completely new phase. Every housing market cycle eventually reaches the same turning point. Not a sudden collapse, not a dramatic headline, but something quieter, a shift in belief. Because housing markets are built on a simple expectation, the belief that buying today will be more expensive tomorrow. That expectation drives urgency. It pushes buyers to stretch their budgets, to waive inspections, to compete aggressively for homes. But when that belief begins to weaken, the entire dynamic changes. And that shift in psychology is often the true beginning of a housing slowdown. At first, the change is subtle. Buyers hesitate before making offers. They start negotiating again. They ask sellers for repairs, for concessions, for price reductions, things that were nearly impossible during the peak of the housing boom. But over time, those small changes accumulate. Sellers begin adjusting expectations. Listings stay active longer. And gradually, the market transitions from a seller's market to something much more balanced. History shows this pattern again and again. In the late 1980s housing boom, rapid price growth across parts of the United States eventually slowed when interest rates rose and buyers became cautious. In the mid-2000s housing bubble, the shift happened even more dramatically. By 2005, home prices had already reached unsustainable levels in many markets. But the majority of buyers didn't realize the danger until much later. Because the early signals looked harmless, homes simply took longer to sell. Price growth slowed. Some sellers offered incentives. But those small signals were the beginning of a much larger adjustment. And today, some of those early patterns are quietly appearing again. Across several regions, homes are remaining on the market longer than they did during the frenzy of 2021. Price cuts are becoming more visible. Builders are offering mortgage rate buydowns to attract buyers. And sellers are increasingly willing to negotiate. These are not signs of panic, but they are signs of change. Because in a truly overheated market, sellers rarely need to compromise. When they begin doing so, it suggests demand is no longer as overwhelming as it once was. Another signal buyers often overlook involves expectations. During the height of a housing boom, forecasts are usually extremely optimistic. Analysts predict continued price growth. Media coverage focuses on rising demand. And the narrative becomes self-reinforcing. But expectations can shift quickly. If buyers begin believing that prices might stabilize or even decline, the urgency to purchase fades. Why rush into the largest financial decision of your life if waiting might offer better opportunities? That single question can alter the pace of an entire market. Because housing demand is not only about necessity, it's also about timing. When buyers feel confident that waiting may benefit them, many choose patience. And patience reduces momentum. The housing market we see today sits at an interesting crossroads. On one side, supply remains relatively constrained compared to historical norms. Millions of homeowners still hold extremely low mortgage rates and have little incentive to sell. This limits the number of homes available. But on the other side, affordability remains one of the most stretched in modern housing history. High home prices combined with elevated mortgage rates have pushed monthly payments to levels many buyers struggle to afford. That tension creates uncertainty, and uncertainty often leads to slower markets. The question now is not whether housing demand still exists. People will always need homes. Families will always form households. Life events will always push people to move. The real question is this: at what price and at what monthly payment are buyers willing to act? Because affordability ultimately places a ceiling on how far prices can rise. When that ceiling is reached, the market must adjust. Sometimes through falling mortgage rates, sometimes through rising incomes, and sometimes through price corrections. No one can predict the exact path with certainty. Housing markets are complex. They vary by region, by city, even by neighborhood. Some areas may remain resilient. Others may experience sharper adjustments. But history offers one reliable lesson. Housing markets move in cycles. Booms create optimism. Optimism pushes prices higher. Eventually, affordability becomes stretched. Demand slows, and the cycle begins to shift again. Right now, many of the ingredients that appear near the end of housing booms are visible. Rising interest rates, stretched affordability, shifting investor activity, and slowing transaction volume. None of these signals guarantee a crash, but they do suggest something important. The era of effortless price growth may be ending. For buyers, that realization changes the entire strategy. Because the most important question is no longer simply, can I buy? It becomes something deeper. Should I buy right now? And the answer to that question depends on patience, information, and understanding the bigger picture. The housing market is one of the slowest financial systems in the world. Its changes often happen quietly at first, almost invisibly, until one day the new reality becomes obvious to everyone. By then, the early signals are long gone, and the opportunity to make decisions calmly has passed. That's why the smartest buyers don't just watch prices. They watch momentum. They watch affordability. They watch the balance between supply and demand. Because the housing market rarely collapses without warning. The clues are almost always there, hidden in data, in behavior, and in the subtle shifts that most headlines overlook. So the next time you hear someone say the housing market can only move in one direction, pause for a moment, look a little deeper, and remember something history has proven again and again. Every housing boom eventually reaches a turning point. The only question is whether buyers recognize it early, or only after the market has already changed. And right now, that turning point might already be beginning.